Robinhood is an attractive stock. Its outstanding unit economics and marketing effectiveness prove that its unique products generate organic demand. Its impressive EBITDA margin is a testament to its highly efficient business model, and its growth over the past 3 years shows that the company has gained control of its fixed costs. Strong free cash flow generation puts the company ahead of the competition, and its increased profitability means it has even more cash to invest or distribute than before. Average revenue per user has increased dramatically over the past 2 years, indicating significant growth in customer monetization. Robinhood is an outstanding company. The valuation looks fair based on its quality, so now may be a favorable time to buy its stock. At $40.58 per share, Robinhood trades at a forward EV to EBITDA multiple of 33.6x. Yes, the stock's seemingly high valuation multiple could mean short-term volatility. But given the quality of the business, experts believe the multiple is justified. It is generally accepted that the size of the return is primarily influenced by the purchase price of the stock. However, extensive retrospective analysis proves that investors should be more concerned about the quality of a company's business than the entry price if the ultimate goal for them is long-term profitability. Robinhood is an online consumer finance platform known for its commission-free trading of stocks and cryptocurrencies. Its mission is to democratize finance. Historically, the average trader paid high brokerage fees to place buy and sell orders. Robinhood's founders, Vlad Tenev and Baiju Bhatt, mathematicians and Stanford roommates, sought to lower customers' barriers to entry by pioneering commission-free trading. Commission-free trading uses algorithms to take customer orders and route them to market makers. In exchange for providing the trade, the router takes a percentage of the market maker's profits. This is called an order flow fee, which generates a huge portion of Robinhood's trading revenue. Today, Robinhood not only earns revenue from order flow fees, but also from interest on margin trading loans, interest on uninvested cash, and Robinhood Gold subscription fees. Robinhood Gold costs $5 per month and gives users access to premium features such as 24/7 trading, cheaper margin loans, higher interest rates on uninvested cash and research reports. Because it is a software company, Robinhood has fewer employees and a more efficient cost base than its older competitors. Robinhood's long-term strategy is to increase the number of users and assets it serves by turning the platform into a one-stop store for consumer finance. The company plans to accomplish this by rolling out products such as retirement accounts and credit cards. Investors under the age of 35 make up the majority of Robinhood's user base, as the company has no minimum account amounts and originally built its products exclusively for mobile devices. Financial services company Robinhood missed market expectations for Q3 2024 earnings, but sales rose 36.4% year-over-year to $637 million. Its non-GAAP earnings of 25 cents per share were in line with analysts' consensus estimates. Here are Robinhood's 2024 Q3 highlights. Revenue, $637 million versus analysts' estimates of $658.2 million, up 36.4% year-over-year, down 3.2%, adjusted EPS, 25 cents versus analysts' forecasts of 26 cents, in line. Adjusted EBITDA, $268 million versus analysts' forecasts of $274.2 million, 42.1% margin, down 2.2%, operating margin, 23.7% compared to 15.6% in the same quarter last year. Free cash flow margin, 281%, up from 6.9% in the prior year quarter. Financial customers, 24.3 million, an increase of 1 million from the prior year quarter. Market capitalization, $34.16 billion. Financial technology companies are capitalizing on growing consumer demand for digital payments, banking and finance. Coincidentally, this trend is being fueled by e-commerce, as well as improvements in blockchain infrastructure and AI-based credit underwriting that make access to money faster and cheaper. Despite regulatory scrutiny and resistance from traditional financial institutions, fintechs are poised for long-term growth as they disrupt outdated systems, expanding financial services to underserved populations. Robinhood's competitors include Charles Schwab, Fidelity, Interactive Brokers, Coinbase and private equity firms M1 Finance and Webull. A company's long-term sales performance can indicate its overall quality. Any business can produce a good quarter or two, but many sustainable companies grow for years. Over the past 3 years, Robinhood has increased its sales by a respectable 10.8% annual compounded growth rate. Her growth has been slightly above the average consumer internet company and shows that her offerings are resonating with customers. Robinhood posted a remarkable 36.4% year-over-year revenue growth in the quarter, but revenue of $637 million fell short of Wall Street's rosy estimates. Looking ahead, the issuer's analysts expect revenue to grow 12.5% over the next 12 months, an acceleration from the last 3 years. This forecast is above the sector average and implies that the company's new products and services will drive better gross margins. As a fintech company, Robinhood is driving revenue growth by increasing both the number of users on its platform and the number of transactions they make. Over the past 2 years, the number of Robinhood's financial customers, a key performance metric for the company, has grown at a 2.4% annualized rate to 24.3 million in the most recent quarter. This growth rate is one of the lowest in the consumer internet sector. If Robinhood wants to accelerate growth, it will likely need to better engage users with its existing offerings or innovate with new products. Robinhood added 1 million financial customers in Q3, resulting in year-over-year growth of 4.3%. The quarterly result was higher than the 2-year result, indicating that new initiatives are accelerating user growth. Average revenue per user, ARPU, is a critical metric for tracking fintech companies like Robinhood, as it measures how much a company earns in commissions from each user. ARPU also provides unique information for analysis about the average transaction size on its platform and Robinhood's take rate, or cut rate, on each transaction. Robinhood's ARPU growth has been exceptional over the past 2 years, averaging 31.4%. Its ability to increase monetization while growing the number of financial customers demonstrates the value of its platform, as its users are paying significantly more than they did last year. Robinhood's ARPU was $105.07 in the quarter. It grew 30.8% year-over-year, faster than her financial customers. A company's gross profit has a significant impact on its ability to implement pricing policies, develop new products, and invest in marketing. These factors can determine the winner in a competitive market. For fintech companies like Robinhood, gross profit shows how much money the company has left after covering the base cost of its products and services, which typically includes transaction, payment processing fees, hosting and bandwidth fees, and costs necessary to attract customers, such as identity verification. Robinhood's gross margins are among the best in the consumer internet sector, which is a result of its business model with minimal assets and strong pricing power. This also allows the company to fund large investments in new products and marketing during periods of rapid growth to achieve higher profits in the future. As you can see below, it has averaged a phenomenal gross margin of 84.9% over the past 2 years. This means that Robinhood has paid its providers just $15.06 for every $100 of revenue. Robinhood's gross margin was 86% this quarter, up 3.2% from 82.9% in the same quarter last year. Robinhood's annual profits have also been on the rise over the past 12 months, up 3.6%. If this trend continues, it could mean better unit economics due to greater leverage from growing sales on a fixed portion of the cost of goods sold, e.g. servers. Consumer internet companies like Robinhood grow through a combination of product virality, paid advertising, and incentives. Robinhood is extremely efficient at acquiring new users, spending only 10.8% of its gross profit on sales and marketing expenses over the past year. This efficiency indicates that it has a highly differentiated product offering and a strong brand reputation, which gives Robinhood the freedom to invest its resources in new growth initiatives while maintaining optionality. Investors often analyze operating income to understand the underlying profitability of a business. Like operating income, EBITDA is a common measure of profitability for consumer internet companies because it eliminates various non-recurring or non-cash expenses, offering a more normalized view of profit potential. Robinhood has been a well-oiled machine over the past 2 years. It has shown impressive profitability for a consumer internet business, with an average EBITDA margin of 34.3%. This result is not surprising as its high gross margin gives it a favorable starting point. Looking at profitability trends, Robinhood's EBITDA margin has grown 28.1% over the past few years as sales growth has provided the company with tremendous operating leverage. The growth was solid, and since its EBITDA margin grew more than its gross margin, we can conclude that it has been more efficient recently with expenses such as marketing, R&D and administrative overhead. Investors track changes in earnings per share, EPS, for the same reason as long-term revenue growth. However, compared to revenue, EPS emphasizes whether the company's growth is profitable. Over the past 3 years, Robinhood's annual EPS has gone from negative to positive. This is a good sign showing that the company is at a trend reversal point. While EBITDA is certainly useful for evaluating a company's performance, experts believe that cash is the deciding factor, as accounting earnings cannot be used to pay the bills. Robinhood has shown terrific cash profitability due to its profitable business model and cost-effective customer acquisition strategy, which allows it to outperform competitors by investing in new products rather than sales and marketing. The company's free cash flow has been one of the best in the consumer internet sector, averaging a stunning 61% over the past 2 years. In hindsight, Robinhood's margins have grown significantly over the past few years. This is encouraging as its free cash flow margin has grown more than its operating margin, suggesting that it is becoming a less capital-intensive business. Robinhood's free cash flow was $1.79 billion in Q3, equivalent to a margin of 281%. Its cash flow turned positive after turning negative in the same quarter last year, confirming its favorable historical trend. Companies that maintain excess cash face less risk of bankruptcy. Robinhood is a profitable, well-capitalized company with $10.16 billion in cash and $7.31 billion in debt on its balance sheet. That $2.85 billion net cash position represents 8.3% of its market capitalization and gives it the freedom to borrow money, return capital to shareholders, or invest in growth initiatives. Is now a good time to buy Robinhood? When considering investing in Robinhood stock, investors should consider its valuation and business qualities, as well as what happened over the last quarter. Robinhood is a high-quality business that is worth owning. To start with, its revenue growth has been decent over the past 3 years, and its growth is expected to accelerate even more over the next 12 months. In addition, Robinhood's impressive EBITDA margin shows that it has a highly efficient business model. Robinhood's EV to EBITDA ratio based on the next 12 months is 33.6x. Investors get what they pay for, and in this particular situation, Robinhood's higher valuation ratio is fully justified as her fundamentals shine brightly. Experts believe that her securities deserve a place in any investment portfolio. Wall Street analysts forecast a 1-year stock price target of $60, up from the current share price of $40.81, representing a plus 47% upside. The near-term long-term target is to re-high the post-IPO high of $85, plus 4400 points, reached after the 07-21 IPO.